At 9:30 a.m., the market opens to a flurry of retail activity, with millions of users clicking through high-speed, colorful interfaces. Behind these screens, supercomputers have calibrated a system that operates with the mathematical precision of a digitized slot machine. The architects of this system operate from these corners, designing the mechanics of the game to ensure the house maintains a permanent advantage. The center of the current retail craze is the 0 DTE option, contracts with 0 days left until they expire. These are high-velocity bets, opened and closed before the final bell rings. This chart shows the total volume of all S&P 500 options. Look at this highlighted section. Over 40% of all daily volume is now tied to 0-day contracts, a shift that has redefined how prices move on an hourly basis. Retail traders buy into these cheap, out-of-the-money calls, risking their principal on the hope of a 1,000% return by the end of the afternoon. The perception of a rapid shortcut to wealth has a hidden cost. By chasing these lottery-style returns, retail traders provide the exact liquidity needed to trigger a mathematical trap. By midday, the environment changes. On the other side of these trades, high-frequency algorithms and market makers take the position of the house. These firms operate under a strict rule. They do not gamble on the market's direction. Instead, they execute dynamic hedging to keep their own books perfectly neutral. This is the Gamma trap. As retail buys call options, AI instantly trades the underlying stock to balance the scale and neutralize risk. This hedging creates a pinning effect that immobilizes the market price. Suppressed volatility prevents the stock from reaching the strike price. When a midday trade fails, it is rarely a matter of bad luck. It is the calculated consequence of being pinned by an automated defense system. In the late afternoon, the pressure intensifies. Institutional firms are almost exclusively on the sell side of these 0 DTE contracts. They utilize what quants call a Theta engine, an AI system that calculates the exact mathematical probability that your option will expire as a total loss. With the price pinned, the final weapon is the ticking clock. This is theta, or time decay, and its curve is absolute. Every tick facilitates a massive wealth transfer. Residual value drains from the buyer and flow directly to the institutional seller. Wall Street firms use these mathematical engines to harvest the time decay of every retail position left on the board. At 4 p.m., the closing bell rings. The lifespan of the 0-day contract reaches its absolute end. Between the algorithmic pinning and the mathematical certainty of time decay, the retail option is now worthless. The house completes the sweep. The market maker captures exactly 100% of the premium paid by the retail traders. Continuing to buy 0 DTE options means handing your capital to an algorithm that processes probability millions of times faster than any human brain. Survival for the Solo Quant requires a total shift in approach, moving away from the lottery and toward the business of the casino. Use AI to manage risk, sell the premium, and harvest the decay. To survive this trap, you must become the house.